Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. Markets brace for a seismic Fed shift as a rate cut looms, but beneath the surface, smart money is quietly fleeing tech, triggering a dangerous market divergence. Second, Paramount's $108 billion hostile bid ignites media war. This isn't just a bidding war, it's a massive stress test for the entire credit market. With a secret playbook to bypass regulators, will this multi-billion-dollar crossfire reshape the media landscape forever? Finally, alarm bells ring in housing. A record 45% surge in delistings triggers a seller's strike as a market breakdown imminent. This isn't 2008. It's a high-stakes standoff where a shocking number of deals are collapsing and will reveal the refuge markets where prices are still soaring. Warning. The markets are on the brink of a seismic shift as we brace for the Federal Reserve's crucial rate decision on December 10. With an 87% probability of a 25 basis point rate cut priced in, the stakes couldn't be higher. The S&P 500 dipped 0.32% yesterday, reflecting the market's jitters, while the Nasdaq clung to a 0.3% gain, showing tech's tentative resilience. I'm telling you, this is a critical moment. Stay alert. Let's dissect the situation. The Fed's upcoming decision is the talk of the town, and for good reason. Despite the softening labour market, with a staggering 1.17 million layoffs announced this year, inflation remains stubbornly above the 2% target. The Personal Consumption Expenditures Index is at 2.8%. This tug of war between inflation and employment is forcing the Fed's hand. A rate cut seems like a done deal, but the real focus will be on the Fed's forward guidance. Will they hint at more cuts in 2026 or signal a pause? This is the policy layer's crux. It's a game of expectations, and the Fed's tone could tip the scales. Now, let's talk money flow. The divergence between major indices is a flashing red light. While mega-cap tech stocks are stabilising, there's a quiet but significant rotation into mid-cap and small-cap stocks. The equal-weighted S&P 500's underperformance signals a narrowing breadth. Investors are cautious, trimming financials and industrials in anticipation of the Fed's move. The VIX sits at a complacent 15.41, but don't be fooled, this is the calm before the storm. As Wednesday approaches, volatility is likely to spike. Smart money is already repositioning, and you should be too. On the valuation front, tech stocks face pressure with stretched P/E ratios. Nvidia, despite stellar earnings, has corrected 13% from its highs, and AMD has plummeted 20% last week. Investors are questioning the sustainability of valuations amid competitive threats from custom silicon designs by hyperscalers. This is your cue to act. I'm telling you, trim tech holdings, especially those with P/E ratios above 40 times, and redeploy into undervalued sectors like financials and energy, which are ripe for tactical buying. Sector focus today. Financials and energy are the names to watch. Financials surged nearly 3% as JP Morgan and Goldman Sachs reported blowout earnings, benefiting from high-rate environments. The XLF is your friend here. Energy, trading at a 9% discount to fair value, is buoyed by stable oil prices around $60 a barrel. Consider XLE for exposure. Conversely, tech names like Nvidia and AMD are under pressure. It's time to trim. For contrarian plays, Meta's strategic pivot away from the metaverse into AI has sparked a 3.4% gain, making it a compelling buy at a discount. Consider adding to positions in Meta, Microsoft, MSFT, and Alphabet, Google, as they trade below intrinsic value. Good advice makes you rich. Bad advice costs you a fortune. Listen to me, now's the time for decisive action. In the short term, if the Fed signals a hawkish pause post-rate cut, immediately overweight financials by 3 to 5%, targeting XLF at $42, while underweighting tech by 15 to 25%. For a medium-term play, assuming the Fed hints at further cuts in 2026, act now to overweight semiconductors by 2 to 3% as the sector could rebound, targeting stocks at 4,000. In a defensive stance, if the 10-year Treasury yield breaks above 4.6%, hedge with TLT puts or the SKQQ ETF to protect against equity downturns. Time's running out and the next few days are pivotal. With the Fed's rate decision looming on December 10, volatility is bound to spike. Watch for the November employment report on December 16. If it shows continued weakness, it could validate the Fed's insurance cut narrative and fuel further equity gains. Remember, good advice makes you rich, bad advice costs you a fortune. Now, let's dig into today's most important developments. $108.4 billion. That's the enterprise value of a new hostile bid from Paramount Skydance to acquire Warner Brothers. Discovery, just days after losing a bidding war for the company to Netflix. So the thing is, this massive deal is being financed with $54 billion in debt, which serves as a massive stress test for the high-yield financing market. If major banks can successfully syndicate this huge debt package, it signals a renewed risk appetite in corporate credit. This could unlock a wave of private equity take-private deals that have been stalled by interest rate uncertainty. However, if you zoom out, you'll see another layer of strategy at play. The Paramount bid is backed by a significant influx of Middle Eastern sovereign wealth and private equity. And here's where it gets interesting. The deal is structured in a way that aims to bypass review by CFI US, the Committee on Foreign Investment in the United States, which screens for national security risks. This could be a new playbook for foreign state-linked entities to gain economic exposure to US media without direct governance, a sharp contrast to how investments from some other countries have been treated. Paramount is taking its offer directly to Warner Brothers, Discovery shareholders launching an all-cash tender offer for $30 per share. This is a direct challenge to the Netflix deal valued at $27.75 per share and represents $17.6 billion more in cash for shareholders. But this isn't just about the total price. It's about what these companies believe different parts of the business are worth. For example, there's a huge disagreement over the value of Warner Brothers, Discovery's traditional cable networks, Paramount's bid values. These declining assets are just $1 per share, while Warner's internal estimates put them at $3 per share. This gap is a key barometer for how quickly the market believes legacy media is decaying, and it will dictate the pace of future consolidation and cost-cutting across the entire industry. Paramount CEO David Ellison went on the record declaring, "We're really here to finish what we started. We put the company in play." Now, get this. There's something called the merger arbitrage spread. It's the gap between Warner's current stock price and the offer prices from Paramount and Netflix. You know, this spread is a living, breathing indicator of the market's confidence that the deal will actually get approved by regulators. A narrow gap means investors are optimistic. A wide gap means they see trouble ahead. So by watching this spread, you're essentially watching Wall Street place real-time bets on the political and regulatory outcome. The story then takes a more personal turn. Ellison claims that after he upped his bid, he never heard back from Warner Brothers, Discovery's CEO. Ellison says he even texted the WBD chief, stating that $30 a share wasn't his best and final offer, signaling he's willing to go even higher. The conflict has now ignited a war of words. Netflix co-CEO Ted Sarandos fired back at Paramount's bid, stating that Paramount's plan implies $6 billion in synergies, and asking, where do you think synergies come from? Cutting jobs? So we're not cutting jobs, we're making jobs. The fight is now shifting to the regulatory arena. When we place Paramount's antitrust argument alongside Netflix's defense, the core conflict for regulators becomes crystal clear. What exactly is the relevant market? Is it just streaming services competing against each other? Or is it a broader market that includes streaming, traditional linear TV, and movie theaters altogether? The US Department of Justice's decision here will set a critical precedent. It will define the competitive landscape for tech and media for the next decade. Much like its recent decision to block the merger of two major book publishers sent shockwaves through that industry. The battle lines are drawn, with Paramount going directly to shareholders, Netflix defending its victory, and Warner Brothers Discovery caught in a multi-billion-dollar crossfire that will reshape the entire media landscape. So looking ahead, keep an eye on the stock price of Warner Brothers Discovery. The smaller the gap between its price and the $30 offer from Paramount, the more likely the market thinks that deal will succeed. Also, listen for any statements from the Department of Justice or the FTC, as their view on what constitutes a market will be the ultimate deciding factor. We were just talking about a massive stress test in the corporate credit world, but a different kind of strain is building in a market that hits much closer to home for most Americans. Housing, a record number of home sellers are pulling their listings off the market. The listings are up a staggering 45.5% year to date. the highest level since tracking began in 2022. A delisting is essentially a seller's strike. It happens when homeowners decide to take their property off the market without a sale. And actually, this is a major leading indicator of housing market sentiment. Sellers, seeing a cooling market, would rather wait for better conditions than accept a lower price, signaling a potential breakdown in their pricing power. A new report from Realtor.com calls it an unusually high rate, as about 6% of all active listings are now vanishing each month. This isn't just a winter slowdown. The trend of sellers retreating has been elevated for 5 straight months. And this trend has huge implications for the broader economy. If sellers continue to hold out and are eventually forced to cut prices, it could lead to a faster than expected slowdown in shelter inflation. That's a major component of the overall inflation rate, and a rapid cooling here would give the Federal Reserve the justification it might need to cut interest rates sooner than anticipated. The situation presents a fascinating duality. On one side, you have sellers who watch prices soar for years holding out. On the other, buyers are fleeing to what are being called refuge markets. This is creating a split or bifurcation in the American housing market. These refuge markets are typically smaller, more affordable metropolitan areas that are still seeing prices rise because demand remains strong. For instance, while prices in former hotspots like Miami and Denver have stalled, they're up over 5% in places like Grand Rapids, Michigan, and Street. Louis, Missouri cities where home prices are still 20% to 30% lower than the national median. Believe it or not, this divergence means national housing data can be misleading, masking significant stress in some regions while others boom. This complicates the narrative of a uniform soft landing for the economy. But that's not the whole picture. For the deals that times being made, a shocking number are falling apart. Nationally, 15% of home purchase agreements were cancelled in October, well above pre-pandemic levels. In some cities, the numbers are even more dramatic. In San Antonio, more than 1 in 5 pending sales, 21% collapsed. The rate of cancelled contracts is, a real-time barometer for household financial fragility. When buyers back out of a deal, it's often because they couldn't secure a loan due to tightening credit standards, or they simply got cold feet about the economy and their own financial stability. This trend could be an early warning sign of weaker consumer spending and even rising loan delinquencies down the road. As Realtor.com's chief economist put it, higher rates and years of rapid price growth have rewritten the rules of engagement for both buyers and sellers. It's crucial to place this situation alongside the 2008 crisis to see just how different it is. Unlike that credit-driven collapse, today's correction is defined by the seller's strike we just talked about. Homeowners today are sitting on record levels of home equity on average, over $200,000 in tappable equity. They are wealthy on paper. This isn't a crisis of bad loans and foreclosures. Instead, it's a standoff, which suggests a prolonged slump in transaction volume rather than a catastrophic price crash. The economic pain will likely be focused on sectors that rely on home sales, like construction, home furnishings, and real estate services instead of a systemic financial crisis. This entire market shift is happening while the national median home price is still 36% higher than it was before the pandemic, creating a high-stakes standoff between what sellers want and what buyers can actually afford.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.